Have you ever found yourself navigating the Canadian financial landscape? Maybe, opening an account, getting a mortgage, or just wondering what makes our banking system so uniquely stable? And, well, in these ever-shifting economic winds, what truly differentiates the major players beyond just their branding? Well, today, we're pulling back the curtain on one of those giants, the Canadian Imperial Bank of Commerce, or CIBC, known by its ticker symbol CM. As Canada's fifth largest bank, CIBC is currently navigating a fascinating mix of opportunities and challenges. It's a compelling story of a bank finding its niche in a concentrated market while looking to expand its horizons. We've brought together a comprehensive stack of sources for this deep dive, everything from detailed investment analyses and strategic reports to in-depth financial performance reviews and market comparisons. Our mission for you, our listener, is really to cut through all the financial jargon, extract the most important insights, and give you a crystal clear, well-rounded understanding of where CIBC stands today, what its strategic direction is, and, well, where it's headed in the future.
Precisely. And understanding a key player like CIBC, it offers a much broader perspective than just a single institution. It provides, I think, a unique window into the broader health and future trajectory of the Canadian economy itself, given how central these banks are to our national financial stability. And remarkably, there are often valuable lessons here that are applicable to the global financial sector as a whole. It's about seeing the intricate threads, that connect individual corporate strategies to the wider financial stability that we all depend on in our daily lives.
That's a crucial point. So over the next little while, we're going to unpack CIBC's specific place within the tight-knit Canadian banking oligopoly. We'll examine its ambitious U.S. growth strategy, explore the significant impact of recent interest rate shifts, first rising, and now gently falling, and critically assess what its future might look like in an era of accelerating digital transformation and the coming revolution of open banking. Let's get right into it. Okay, so to truly understand CIBC, we first need to appreciate the unique playing field it operates on, the Canadian banking landscape. It's famously stable, incredibly robust, and, dare I say, a bit of an exclusive club. At its core, it's dominated by what everyone refers to as the Big Six banks. That's RBC, TD, Scotiabank, BMO, CIBC, and National Bank. Now, if you look at the Big Five, which excludes National Bank, these powerhouses command over 86% of the entire Canadian market. Wow. And when you factor in the Big Six collectively, they hold over 93% of the banking system's total assets, a statistic that firmly establishes them as systemically important banks, or DSIBs.
Right. And what's noteworthy here is that this oligopolistic structure isn't merely a historical curiosity. It's a fundamental economic moat, almost like a medieval fortress surrounding the financial system. Think of it. We've got incredibly high customer switching costs. Moving all your accounts, your mortgages, your investments, it's a significant hassle, right? It's a form of financial inertia that really benefits the incumbents. Then there are these massive low-cost deposit bases that provide an unparalleled funding advantage to these established players. And critically, it's a remarkably rational competitive environment, which means we rarely see the kind of aggressive, destabilizing price wars that could undermine the sector. This entire structure is further bolstered by a strong regulatory framework, creating formidable barriers to entry for new players. It's not just a big bank. It's a bank operating within an incredibly well-protected ecosystem. That DSIB designation, by the way, it isn't just a fancy title. It mandates even stricter capital requirements and regulatory oversight because these banks are so integral to national economic stability that their failure would trigger widespread systemic risk.
So the practical implication here for you is that Canadian banks operate in a very different playground compared to, say, their counterparts in the U.S. or Europe. This structure brings a certain level of predictability and financial stability, which is, comforting. However, it also creates unique competitive dynamics that shape how each bank, and especially CIBC as one of the slightly smaller Big Six members, has to strategically carve out its own path. They can't just rely on sheer size. They have to be smarter about their approach, I guess. Now, despite these foundational strengths, the near-term operating environment for Canadian banks is presenting some real headwinds. Fitch Ratings, a major credit rating agency, actually revised its outlook for the entire Canadian banking sector from neutral to deteriorating in mid-2024. This was largely driven by a softer economic forecast for Canada, moderating labor markets across the country, and what's consistently been a huge elephant in the room, elevated household debt levels.
Yeah, and if we connect this to the bigger picture, The Bank of Canada has consistently, for years now, highlighted high household indebtedness as a systemic vulnerability. It's not just a concern for individual families struggling with payments, it poses a significant risk to the stability of the entire financial system. The rapid adjustment to much higher interest rates that we've witnessed over the last couple of years has been an ongoing challenge, really testing the resilience of households and businesses alike to service their debts under these new, tougher conditions. This directly impacts how banks like CIBC assess credit risk and manage their vast loan portfolios. It's a huge factor.
And just when we thought the rate hikes were, maybe a permanent fixture, we saw a pivotal shift in June 2024. The Bank of Canada began lowering its policy interest rate. This isn't just a minor adjustment, it signals a fundamental turn in monetary policy, moving from a period of tightening to one of easing. This change is widely anticipated to offer some much-needed relief to borrowers who've been struggling with elevated mortgage payments and lines of credit, and it's also expected to stimulate interest rate-sensitive sectors of the economy, particularly housing.
That's the million-dollar question, isn't it? On one hand, a rate cut can be a welcome relief for borrowers, easing the pressure on loan defaults and potentially reducing the bank's provisions for credit losses, which we'll definitely discuss more later. But there's a flip side. How quickly will that lower rate eat into the net interest margin, which is that crucial spread banks earn between what they pay depositors and what they charge borrowers? If deposit rates don't fall as quickly as lending rates, or, if loan growth remains muted, that core profitability could be squeezed. It's a delicate balancing act, and the market will be watching closely to see if this easing is a net positive for CIBC's bottom line, or if it presents a new set of challenges in revenue generation.
Okay, so with that unique Canadian banking backdrop in mind, let's zoom in on CIBC itself and its specific place within this hierarchy. CIBC currently stands as the fifth largest bank, with a market capitalization hovering around C$59.31 billion and total assets approaching C$976 billion as of the end of fiscal year 2023. This firmly positions it a notch below the truly massive players like RBC, TD, BMO, and Scotiabank. Its domestic market share, while substantial, hovers around 10.5%. And to give you a clear sense of that scale difference, RBC, the undisputed market leader, had a market cap of $187.21 billion at roughly the same time. That's more than 3 times CIBC's. This relative positioning means CIBC can't afford to simply throw money at every market segment or try to compete head-to-head on sheer breadth with the truly dominant players. Instead, it demands a much more strategic, focused approach. It has to be smarter, I think, about where it allocates its resources and how it differentiates itself.
Exactly. CIBC's strategy isn't about matching the sheer volume or pervasive reach of an RBC or TD. Instead, it's characterized by highly targeted growth. Management has been incredibly clear in articulating their 4 core strategic priorities. First, they are intensely focused on growing their mass affluent and private wealth franchise across both North America. Second, they're committed to expanding their digital-first personal banking capabilities. Third, a crucial element is enhancing connectivity across all their various business lines. And finally, they are dedicated to simplifying their operations and strengthening the bank's foundational processes. This specific focus, this targeted approach, is a direct strategic implication of its scale. It's about identifying profitable niches in areas where it can genuinely differentiate and compete effectively. This isn't just good business, it's an absolute necessity for sustained growth and profitability when you're up against rivals 3 times your size in a mature market.
So when you hear about their emphasis on the mass affluent client segment, those with significant but not necessarily ultra-high net worth, or their drive to build a leading digital experience, these aren't just fashionable buzzwords. They're a direct, pragmatic response to this need to be distinct, efficient, and deeply client-focused. It's about serving a specific, profitable client base exceptionally well, rather than, trying to be all things to all people. Beyond that broad oligopoly moat we discussed, CIBC has been actively cultivating specific competitive advantages. Their strategy truly centers on a modern, relationship-oriented model, aiming to provide differentiated advice and a seamless client experience across their physical branch network, which still numbers over 1,100 locations, and their increasingly sophisticated digital channels. A key strength that genuinely stands out and often flies under the radar is the prowess of its digital platform. In a major 2024 J.D. Power study, CIBC Investors Edge, their self-directed investing platform, actually ranked #1 in self-directed investor satisfaction among the big 5 banks. That's a powerful testament, really, to their significant investment and successful execution in that digital space.
Yes, and what's truly noteworthy here is how CIBC is strategically adapting to the evolving financial landscape. While customer relationships in Canadian banking are inherently sticky due to the switching costs we talked about, the real long-term threat isn't just traditional rivals. It's increasingly coming from agile fintech disruptors like Wealthsimple or Nuvei, who excel at unbundling traditional banking services by offering highly specialized digital-first products that can be incredibly compelling for specific client needs. CIBC's deep digital focus, therefore, isn't just about chasing new market share. It's a critical defensive strategy. It's about protecting its valuable fee-based revenues from erosion by these agile new competitors and ensuring their foundational services remain competitive, relevant, and engaging in a rapidly evolving digital world. They're safeguarding their core business while simultaneously reaching for growth. It's quite smart, actually.
So consider this. When you see a bank pouring resources into enhancing its mobile apps or digital tools, it's not merely about convenience for you, the customer. It's a strategic battle for the future viability and profitability of their entire business model. They're making sure that you don't jump ship to a trendy new fintech just because its app is sleeker or offers a slightly better niche service. It's about securing long-term loyalty in a fragmented digital ecosystem. Looking ahead, a significant regulatory evolution is definitely on the horizon for the Canadian banking sector. The implementation of a national consumer-driven banking, or more commonly known as open banking, framework. The federal government has ambitious plans, aiming to introduce foundational legislation for this in 2024 and 2025. This framework is set to fundamentally change how you interact with your financial data, allowing you, as a consumer or a small business, to securely and seamlessly share your financial information with accredited third parties via standardized application programming interfaces, or APIs.
This is a monumental shift because it will replace the less secure and often problematic screen scraping methods that some apps currently use, where you effectively have to hand over your sensitive banking login credentials. Yikes.
Right, and this brings up a key challenge and opportunity. Will this shift truly empower consumers, or will it simply introduce new layers of complexity and risk? For incumbents like CIBC, it's undeniably a double-edged sword. On one side, it explicitly lowers data friction and significantly reduces switching costs, which have historically protected the Big Six from aggressive competition. It makes it far easier for customers to use specialized fintechs for everything from targeted lending and payment solutions to personalized investment advice, potentially commoditizing core banking functions and eroding those valuable fee revenues that banks rely on. However, this also presents a substantial opportunity. Banks that can leverage their vast existing data sets, their established brand trust, and their enormous client relationships can position themselves as central, trusted hubs in this new ecosystem. The institution that owns the client interface, the one you choose to interact with most frequently for your holistic financial needs, will be best positioned to thrive. CIBC's robust and forward-looking digital strategy, with its strong emphasis on a seamless, integrated client experience, directly prepares for this new competitive paradigm. They're aiming to play both strong offense and defense simultaneously, I think.
So for you, this means a new level of power and control over your financial data, and potentially a lot more options for how you manage your money. Imagine having all your financial accounts, loans, and investments, even from different providers, viewable and manageable through a single, secure, and trusted interface. But it also means exercising more discernment in deciding who you trust with that data, and that's a huge seismic shift in how banking might fundamentally feel in the coming years. It's a new frontier, both exciting and, well, maybe a little daunting. Beyond these domestic regulatory shifts, CIBC also nurtures significant global ambitions. While they maintain international operations in regions like the Caribbean, Asia, and the UK, the true cornerstone of its long-term growth strategy is its dedicated U.S. platform. This critical expansion was significantly bolstered by a strategic acquisition back in 2017 of the Chicago-based The Private Bancorp, which they subsequently and very deliberately rebranded as CIBC Bank USA.
Yeah, their U.S. strategy is remarkably targeted and focused. They aren't attempting to build a massive, sprawling retail bank across the entire U.S. like, say, TD did. Instead, they're concentrating on relationship-oriented commercial banking and private wealth management, specifically targeting middle-market companies and high-net-worth individuals. They aim to find those profitable niches where their relationship-based, advice-driven approach can genuinely shine and differentiate them. A clever aspect of this strategy is their offering of specialized solutions for Canadian clients doing business in the U.S., like U.S. dollar accounts and mortgages that can actually be qualified for using Canadian credit history. This intelligently leverages their existing Canadian client base and deep understanding of cross-border financial needs. It's a smart play.
Okay, let's unpack this a bit further. Why such a strong push into the U.S. market? It seems pretty clear. It's a direct, calculated effort to diversify their earnings streams and crucially mitigate the concentration risk they have in the Canadian residential mortgage market, a topic we'll definitely dive into more depth on shortly. For CIBC, expanding into the U.S. is a necessary move for long-term growth and stability because, as we've seen, relying too heavily on one market, even a stable one like Canada, can expose them to undue sector-specific or macroeconomic risks. The U.S. offers a massive, albeit highly competitive market for this kind of targeted expansion, providing a vital diversification runway. All right, so with all that strategic context, how exactly does CIBC make its money day to day? The bank operates through 4 distinct yet interconnected business segments, each contributing to its overall revenue and profitability. The largest and most foundational is Canadian Personal and Business Banking, PNBB, which serves millions of individual Canadians and countless small business clients across the country.
This segment alone generated a substantial $2.4 billion in adjusted net income in fiscal 2023. Pretty significant. Next, we have Canadian Commercial Banking and Wealth Management, CWM, which offers high-touch, customized services for middle-market companies and high-net-worth individuals, and notably includes their award-winning CIBC Investor's Edge platform. This segment contributed a solid $1.88 billion in adjusted net income in fiscal 2023. Then there's their increasingly vital U.S. Commercial Banking and Wealth Management arm, which is clearly their primary growth engine outside of Canada, targeting similar client bases south of the border. This segment generated $420 million in adjusted net income in fiscal 2023, though, as we'll explore, its performance can be quite volatile. And finally, we have Capital Markets and Direct Financial Services, CM&DFS, a segment that encompasses global markets operations, investment banking, corporate lending, and also houses their successful direct digital banking brand, Simply Financial. This segment brought in $1.99 billion in adjusted net income in fiscal 2023.
Yeah, what's particularly noteworthy there is the inherent volatility we observe in the U.S. CWM segment's earnings. You mentioned $420 million in fiscal 23, but that was after a sharp 48% decline from the previous year. That reflected challenging U.S. economic conditions and the rapid interest rate cycle during that period, which significantly impacted loan demand and asset valuations. However, the story pivoted dramatically with a sharp rebound in Q2 and Q3 2024, showing net income up 73% and $142 million year over year, respectively, in those quarters. This pattern underscores a crucial insight. While U.S. expansion is absolutely vital for long-term diversification, its earnings contribution is highly sensitive to the economic cycle. It's a high-growth area, but it also carries higher risks, demanding incredibly disciplined underwriting and astute risk management to deliver sustainable value.
Interesting. And when we look at CIBC's revenue structure, it's characterized by a relatively balanced mix between interest-based and fee-based income. For the first 6 months of fiscal 2024, net interest income, NII, which is essentially the profit margin they earned on the difference between the interest on loans and interest paid on deposits, accounted for 52.7% of their total revenue, or to see $6.53 billion. The remaining 47.3%, amounting to $5.86 billion, came from non-interest income, primarily fees and other non-lending sources.
Right, and this split raises an important question about the overall quality and stability of the revenue streams. NII, while the traditional backbone of banking, is highly sensitive to central bank monetary policy and broader macroeconomic factors. When interest rates fluctuate, as they have dramatically, NII can swing significantly. Fee-based income, especially from segments like wealth management, is generally more resilient and recurring. It's often directly tied to assets under management, AUM, or transaction volumes, providing a more predictable and often higher margin revenue stream that is less directly impacted by the relentless churn of interest rate cycles. This balance is really critical for long-term stability.
And this is where the rubber meets the road strategically, isn't it? CIBC's strategic priority to grow our mass affluent and private wealth franchise is a clear, deliberate effort to actively increase that stable, high-margin, fee-based revenue. A successful execution here would significantly de-risk their overall revenue profile, making their earnings less volatile and reducing their heavy dependence on the inherent ups and downs of interest rate cycles. For investors, this could also make the bank a far more attractive proposition, potentially justifying a higher valuation in the market down the road. In line with, well, every modern financial institution, CIBC is heavily invested in its digital transformation journey. They probably report an impressive 86% digital adoption rate within their Canadian personal banking segment, which means a vast majority of their clients are actively engaging with their digital channels. More than just usage, 38% of their core retail product sales are now originating digitally, clearly demonstrating the effectiveness and reach of their online sales funnels. Your direct digital banking brand, Simply Financial, is also a key growth engine. successfully adding a remarkable 180,000 net new clients in the 12 months leading up to Q1 2024. That's quite a number.
Yeah, and beyond just the client-facing platforms, CIBC is pushing deeper into the technological frontier. In 2024, they developed an enterprise AI framework to guide and govern their use of artificial intelligence and are actively piloting generative AI tools across various functions. This isn't just about simple efficiency gains, it's about fundamentally enhancing client service, dramatically improving internal productivity, and ultimately building a profound competitive edge in a digital-first world where data and intelligent systems are rapidly becoming paramount. These kinds of foundational investments are about future-proofing the bank and ensuring its relevance for decades to come.
So if you're using a banking app for your daily transactions, or maybe you're receiving personalized recommendations from your bank, you're directly part of this pervasive trend. For banks like CIBC, it's about making your life easier and more convenient while simultaneously streamlining their own operations and effectively battling those agile fintech disruptors we mentioned earlier. It's an ideal win-win, I suppose, but it demands massive and sustained investment on their part. Okay, let's conduct a quick but thorough financial health check, focusing on CIBC's performance trends between 2022 and 2024, which was a period marked by pretty significant economic shifts. Starting with some key metrics, CIBC's adjusted return on equity, or ROE, stood at 14.0% in Q3 2024. This represents a solid recovery from 13.3% in fiscal 2023, but it's still lagging its 2022 level of 14.7% and critically remains below the bank's own medium-term target of 16% plus cover. This pressure on ROE is primarily due to higher credit losses and the bank proactively holding more capital to cushion against economic uncertainty.
Their net interest margin, or NIM, was 1.50% in Q3 2024. However, the core NIM, which intelligently excludes more volatile trading activities, has actually shown commendable strength, expanding from 1.65% in Q2 2023 to 1.72% in Q2 2024. As for loan growth, it's been relatively modest, up only 1.8% year-to-date by Q3 2024, so kind of sluggish there.
Yeah, and ROE is such a critical metric because it tells us, quite simply, how efficiently a bank is generating profit from its shareholders' equity. The sustained pressure on CIBC's ROE really highlights the ongoing challenge of the normalizing credit cycle and the imperative for banks to maintain robust capital buffers. It's a delicate balancing act. You absolutely want to be profitable and generate strong returns, but you also need to be prudent, safe, and resilient, especially in uncertain economic times. The slight recovery in ROE signals some stabilization, maybe, but there's still a clear path for them to reach their stated target, demonstrating that while they've weathered some storms, they're perhaps not entirely out of the woods yet.
Now, one of the most significant trends impacting CIBC's earnings, and indeed many banks across the industry, has been the normalization of the credit cycle. We're seeing a steady and at times sharp rise in provision for credit losses, or PCL. To give you a sense of the shift, it jumped from just 14 basis points in fiscal 2022 to a notable 30 basis points in fiscal 2023. That's more than double. This trend regrettably continued into 2024, with PCLs hitting C$585 million in Q1, C$514 million in Q2, and C$483 million in Q3. Those are big numbers.
They are. And this naturally leads us to wonder why this significant and sustained increase. It's a direct reflection of higher interest rates and persistent inflation straining borrower finances, which inevitably leads to increased delinquencies and defaults. When the cost of servicing debt rises, some individuals and businesses simply struggle to keep up. PCLs are essentially the money banks proactively set aside to cover these potential future loan losses. So this rise is unequivocally the single largest factor weighing on CIBC's recent earnings performance. It's a tangible, real-time indicator that the economic environment is indeed becoming tougher for many borrowers, and the bank is prudently accounting for that increased risk.
And this is where it really gets interesting, and it highlights a key vulnerability for CIBC, the composition of its loan portfolio. As of April 30, 2024, residential mortgages made up a staggering $274.5 billion, representing over 51% of its total loan book. Wow, over half. That is a huge concentration in the Canadian housing market, which, as we all know, has been a hot topic of conversation, a source of both national pride and, at times, considerable anxiety.
Exactly. And the Bank of Canada, in its various reports, repeatedly identifies high household indebtedness and the potential for housing price corrections as key risks to the Canadian financial system. While CIBC's mortgage portfolio is generally of high quality, characterized by conservative underwriting, the sheer scale and concentration of this exposure mean that a severe economic downturn, particularly one resulting in higher unemployment, could materially increase losses. This concentration risk is a significant and likely reason for CIBC's historical valuation discount compared to its more geographically and functionally diversified peers. Investors definitely factor in that heightened sensitivity to the fortunes of the Canadian homeowner and the broader housing market. It just makes sense.
Right. But despite these credit quality concerns, it's vital to highlight a major positive. CIBC maintains an exceptionally strong capital position. Their Common Equity Tier 1, or CET1, ratio stood at a robust 13.3% as of Q3 2024. This marks a significant increase from 11.7% in fiscal 2022 and comfortably exceeds all regulatory minimums.
Absolutely. And for you, our listener, the strong capital buffer provides immense comfort and a crucial layer of safety. It means the bank possesses substantial capacity to absorb potential credit losses, to support future loan growth, and to invest strategically in its future, all while still being able to return capital to its shareholders. It's a fundamental measure of the bank's resilience against unexpected shocks and a testament to their prudent financial management, reinforcing the overall stability of the Canadian banking system. It's a really important number to watch.
So to give you a recent snapshot of how CIBC measures against its domestic rivals, let's quickly look at Q2 2024 performance across the Big Six. CIBC posted adjusted earnings per share, EPS growth of plus 3%, with reported net income up 4% year over year to $1.75 billion. Solid, if not spectacular. This compares to RBC, which saw a plus 9% adjusted EPS, TD with plus 2% adjusted EPS, but a significant negative 22% reported net income due to a large anti-money laundering charge. Scotiabank at negative 7% adjusted EPS, BMO is a 10% adjusted EPS, though plus 81% reported due to a prior year charge, and National Bank, which enjoyed a plus 9% adjusted EPS. So a mixed bag across the board.
Yeah, and what's particularly compelling here is that while CIBC's growth wasn't necessarily the strongest in absolute terms, its results were remarkably clean compared to some peers. Unlike TD, for instance, whose recorded earnings were significantly skewed by that $615 million provision for investigations related to its anti-money laundering program, CIBC didn't have these large one-time items distorting its performance. This suggests a solid, stable performance from its core operations in what was, frankly, a complex and challenging environment for many of its rivals. It speaks to a degree of operational stability and perhaps less exposure to unexpected regulatory penalties, which is a valuable quality for investors, I think.
Okay, turning our gaze now towards the future. CIBC's strategic growth is clearly driven by those four strategic pillars we discussed earlier. A dedicated focus on growing its mass affluent and private wealth franchise, an unwavering commitment to expanding its digital-first personal banking, a drive to enhance connectivity and differentiation across all its services, and finally, a relentless pursuit of enabling, simplifying, and protecting the bank itself. These aren't just abstract corporate goals, they seem like concrete, actionable directives. And crucially, these strategies are clearly resonating with clients. In the 12 months prior to Q1 2024, CIBC actually added approximately 700,000 net new clients. That's a truly significant number in a mature market like Canada and serves as a powerful indicator that their value proposition, particularly around digital services and targeted wealth offerings, is landing extremely well with a diverse client base. That's impressive growth.
It really is. And wealth management in particular stands out as a cornerstone of this growth strategy, and they're showing impressive momentum. CIBC proudly ranked #1 among Canadian peers in retail mutual fund net sales for 2 consecutive quarters in 2024. That's quite an achievement. This success is translating directly into significant growth in client assets, with assets under administration, AUA, surging from $522 billion at the end of fiscal 2023 to a remarkable $640 billion by Q3 2024. That's a substantial 22.6% jump. If we connect this to the bigger picture, this heightened focus on wealth management is strategically vital. It effectively shifts the bank's revenue mix towards more stable, higher margin, fee-based income, thereby consciously reducing its dependence on the more cyclical and interest rate sensitive net interest income. In capital markets, they're also demonstrating strength, ranking #1 in equity trading and advisory fees in Q2 2024. And notably, U.S. capital markets revenue was up a robust 24% year over year in Q3 2024, signaling traction in their cross-border efforts too.
Right, and the U.S. remains CIBC's most significant geographic expansion opportunity, building diligently on that foundation of CIBC Bank USA for commercial banking and private wealth management. The strategy hinges on what they affectionately term connectivity, which implies seamlessly serving and referring clients across the Canadian-U.S. borders. This isn't just about planting flags in new locations. It's about profoundly integrating their operations to create a truly unified and friction-free client experience across North America, leveraging existing relationships.
Which brings up that key challenge again. Can they successfully replicate their Canadian relationship-oriented model in the notoriously vast and highly competitive U.S. market? It's a big question. Success here would provide absolutely crucial diversification and sustainable growth, potentially allowing them to break out of their historical fifth-place position among Canadian banks and, importantly, command a higher valuation from investors. However, it also carries the highest execution risk. The U.S. financial landscape is fragmented and fiercely competitive, and making a significant profitable impact requires sustained effort, highly disciplined underwriting, and a nuanced understanding of local market dynamics. This is perhaps their biggest strategic bet, wouldn't you say?
I agree. And management is keenly aware of this high-stakes game, and they're watching referral volumes between their Canadian and U.S. businesses as a key performance indicator for this connectivity strategy. And the good news is they're currently on track for significant growth, which is an encouraging sign, I guess, that the integrated approaches start to yield tangible results. Finally, CIBC is investing substantially in technology, pouring resources into deploying advanced AI and sophisticated data analytics, not just for personalized advice, but also for dramatically streamlined operations. They've already realized a significant $140 million in expense efficiencies over the last year alone from various simplification initiatives, clearly demonstrating that these strategic investments are already paying tangible dividends in terms of cost savings and improved operational leverage.
Absolutely. And these substantial technology investments are not just about immediate cost savings. They are fundamentally about future-proofing the bank. We're talking about improved operating leverage, enhanced client acquisition and retention through a superior digital experience, and the cultivation of deeper, more intelligent client relationships through powerful data insights. These are all expected returns on this investment. In essence, they're meticulously building the infrastructure for the next generation of banking, aiming to be more efficient, profoundly more client-centric, and ultimately more competitive in a rapidly evolving digital world.
Now, to be balanced, it certainly hasn't been all smooth sailing for CIBC, especially in the last couple of years. The rapid and aggressive rise in interest rates since 2022 has been the primary headwind, creating significant macroeconomic pressure points across the entire financial system. This unprecedented tightening has led to a noticeable slowing in loan demand as borrowing becomes more expensive, increased funding costs for the bank itself, and, critically, placed immense financial pressure on countless borrowers, which, in turn, contributes to a more cautious and uncertain economic outlook overall.
Yeah, and the practical implication here for you, the listener, is that everything from your personal mortgage rates to the cost of borrowing for small businesses is directly impacted by these large, systemic macroeconomic forces. These forces, originating from central bank policy, ripple through the entire economy, ultimately landing directly on the bank's balance sheets in various ways, significantly affecting their profitability and risk profiles. It's a chain reaction that touches everyone, really.
The most direct and indeed severe financial impact of this challenging environment has been the undeniable deterioration in credit quality, manifesting as steadily rising provision for credit losses. As we mentioned earlier, Q1 2024 saw PCLs of C$585 million, followed by C$514 million in Q2 and C$483 million in Q3, all figures that are significantly higher than previous more benign years.
And what's truly compelling here is that this isn't entirely unexpected in such an economic climate. When interest rates rise sharply and inflation bites into disposable income, households and businesses naturally face greater debt servicing challenges. This sustained rise in PCL is therefore the single largest factor weighing on CIBC's recent earnings performance, as the bank must prudently set aside more capital to cover these potential losses. It's a stark and clear indicator of the financial stress accumulating in the broader economy.
Beyond the macroeconomic challenges, CIBC faces persistent long-term competitive pressure from a growing array of fintechs and agile digital-only banks, a challenge that open banking is expected to intensify dramatically. These nimble players often target specific, high-margin niches, effectively siphoning off valuable revenue streams from traditional banks. Additionally, CIBC, like other large institutions, has incurred some specific, unexpected regulatory charges. In Q1 and Q2 of 2024, for example, CIBC was hit with special assessments by the U.S. FDIC, that's the Federal Deposit Insurance Corporation. These charges totaled C$91 million in Q1 and C$13 million in Q2. They were levied across large depository institutions to cover the substantial costs associated with the failures of several other U.S. banks in 2023.
Right, so it's not just about navigating broad economic shifts. Banks are grappling with new, highly agile competitors, and sometimes they're facing unexpected and sizable costs, like literally contributing to the cleanup for other banks' mistakes. This adds another complex and unpredictable layer to their already challenging operational environment, forcing them to be even more adaptable. It's a tough landscape.
Okay, every bank, by its very nature, manages an inherent array of risks, and CIBC is certainly no exception. They meticulously manage a comprehensive range of inherent risks across all their operations. The biggest by far, and indeed for most banks, is credit risk, which is the risk of suffering losses from borrowers failing to repay their loans. This primarily stems from its substantial loan portfolio, particularly its immense exposure to residential mortgages, which, as of Q2 2024, represented over 51% of its total loan book, that crucial figure again. Then there's market risk, arising from fluctuations in interest rates, foreign exchange rates, and equity prices, primarily concentrated within their capital market segment. Operational risk covers potential losses stemming from internal process failures, increasingly sophisticated cybersecurity threats, and the ever-present danger of fraud, the latter being a growing concern for both the bank and its customers. They also diligently manage liquidity and funding risk to ensure they can consistently meet all their financial obligations without incurring undue losses. And finally, regulatory and legal risk to ensure absolute compliance with the extensive and ever-evolving labyrinth of financial laws and regulations. It's a lot to juggle.
It is, and to truly put that credit risk, particularly the mortgage concentration, into perspective, of its substantial $541.7 billion in gross loans as of April 30th, 2024, a staggering $274.5 billion were residential mortgages. This naturally leads us to that critical question. How profoundly sensitive is the bank's overall health and stability to the fortunes of the Canadian homeowner and the wider housing market? While their mortgage book is generally high quality, this sheer concentration means any significant downturn in Canadian employment or a sharp, prolonged correction in housing prices could have a disproportionate impact on CIBC compared to more diversified institutions. It's just a mathematical reality.
Right. The most significant and oft-discussed concentration risk, as we've highlighted, is indeed their deep exposure to the Canadian residential real estate market. But the bank also maintains exposure to commercial real estate, CRE, particularly the office sector, which has faced significant global headwinds in recent years due to the seismic shifts in work patterns brought about by the pandemic and the rise of remote work.
Yeah, and what's truly compelling here is CIBC's proactive and pragmatic response to these known vulnerabilities. Management has explicitly stated they are actively de-emphasizing certain areas of our institutional commercial real estate business. This prudent de-risking strategy, even if it means foregoing some short-term loan growth in that specific area, signals a conservative, forward-thinking approach to a known systemic vulnerability. It's an important and responsible step, I think, in actively managing that concentration risk, demonstrating a keen awareness of potential sector-specific issues before they escalate.
And to manage this complex web of risks, CIBC has put in place a formal, exceptionally robust enterprise-wide risk management framework. This isn't just a document, it's an active living system meticulously overseen by the Risk Management Committee of the Board of Directors, which sets the bank's overall risk appetite. Crucially, key functions like the Chief Risk Officer operate with a significant degree of independence, ensuring an unbiased and critical approach to risk assessment and mitigation across all business lines.
And this highly structured and independent approach is absolutely fundamental to the bank's stability. It means there are dedicated independent teams whose entire job is to meticulously think about every conceivable way things could potentially go wrong, and then to design and implement robust safeguards to protect the bank and, by extension, your deposits and investments. It's about maintaining financial stability through proactive, comprehensive oversight, which remains a hallmark of the resilient Canadian banking system. You need that strong governance.
Okay, let's turn our attention to what the broader market thinks of CIBC. Its shares have, historically, traded at a noticeable discount to its larger Canadian banking peers. As of August 2025, CIBC traded at a normalized price-to-earnings PE ratio of 12.51x and a price-to-book PV ratio of 1.68x. In stark comparison, RBC, the market leader and often considered the bellwether, traded at a higher PE of 14.08x and a PB of 2.18x, so there's a clear gap.
Yeah, there is. And this naturally leads us to a crucial question. Why this persistent valuation discount? It's rarely arbitrary in financial markets. The market typically rewards higher, more stable earnings growth, greater diversification, and demonstrably lower risk balance sheets. RBC and TD, for instance, benefit immensely from their larger scale, their extensive and well-established U.S. retail operations, and their dominant wealth management franchises. All of these factors contribute to a perceived higher earnings quality and less volatility, which investors are willing to pay a premium for. CIBC's significant concentration in Canadian mortgages, its relatively smaller scale compared to those absolute giants, and the perceived execution risk associated with its U.S. growth strategy all contribute to its persistent valuation discount. It's a direct reflection, really, of the market pricing in these inherent differences and strategic challenges.
But this is where the picture gets really interesting, I think. There are distinct factors that could help CIBC narrow that valuation gap over time. Maintaining strong capital with a CET1 ratio consistently above 13% is a powerful foundation. Secondly, continued momentum in wealth management, which generates that stable, high-quality fee income we discussed, is a significant positive. And perhaps most importantly, successful and profitably executed U.S. expansion would be a huge catalyst, decisively demonstrating diversification and actively reducing that domestic concentration risk. These elements, if consistently delivered, could fundamentally re-rate the stock, couldn't they?
Absolutely. That's the potential upside investors are looking for.
So who is steering this ship through these complex waters? Victor Dodig has been at the helm as CEO since September 2014, leading a multi-year transformation with a remarkably clear and consistent vision to build a modern, relationship-oriented bank for a modern world. The leadership team under him is experienced, with a consistent, well-articulated four-pillar strategic framework that clearly guides all their actions and investments.
Yeah, and what's genuinely compelling here is the strong, almost textbook-like alignment between their stated strategy and their actual execution, consistently supported by tangible, hard data. For wealth growth, they achieved the coveted #1 rank in Canadian mutual fund net sales for 2 consecutive quarters in 2024, with assets under administration surging by 22.6% from fiscal year 2023 to Q3 2024. That's real progress. In digital-first banking, they've hit an impressive 86% digital adoption rate and received multiple industry awards for client satisfaction. Their connectivity and U.S. growth strategy is showing promising results, with U.S. capital markets revenue up a significant 24% in Q3 2024, and U.S. commercial banking net income strongly rebounding. And finally, for enabling, simplifying, and protecting the bank, they've realized a noteworthy $140 million in expense efficiencies while building their CET1 ratio to a robust 13.3%. This is a leadership team demonstrating clear, measurable progress across the board.
Right. This isn't just corporate talk or aspirational statements. This tangible, data-backed progress across all strategic pillars shows a leadership team that's not only setting a clear and ambitious direction, but also consistently and effectively delivering on it, which is absolutely crucial for building sustained investor confidence and for the bank's long-term success. As we look towards the horizon, there are both potential positive and negative catalysts that could significantly impact CIBC's trajectory. On the positive side, a Canadian economic soft landing would be enormous. If Canada manages to avoid a deep recession and unemployment remains relatively stable, then provision for credit losses could come in below current market expectations, directly boosting earnings and shareholder returns. That would be huge. Another powerful catalyst would be sustained profitable growth in their U.S. operations.
Definitely. Consistent profitability and effective risk management within the U.S. commercial and wealth management segment would truly validate their diversification strategy and could lead to a significant re-rating of the stock's valuation by the market. It would signal that their biggest long-term bet is indeed paying off, and paying off well. And finally, accelerated wealth management share gains. Continued outperformance in mutual fund flows and robust assets under management growth would strategically shift the bank's revenue mix further towards that more stable, high-quality fee income, making their earnings stream more predictable and resilient to economic swings.
Okay, on the flip side, there are equally significant potential negative catalysts. A hard landing, or a deep recession in Canada, coupled with a sharp rise in unemployment, would dramatically increase credit losses across all loan portfolios, severely impacting profitability and potentially leading to deeper valuation discounts. That's the big fear, I guess. Another major concern, particularly given CIBC's exposure, is a sharp Canadian housing market correction.
Right. And while a housing correction alone isn't a direct cause of bank losses, unless accompanied by high unemployment, a disorderly or prolonged decline in home prices would severely hurt consumer confidence, significantly reduce demand for new lending, and crucially, increase the potential loss given default on mortgages that do enter foreclosure. This is a critical risk, given the substantial concentration in CIBC's portfolio, and of course stumbles in their U.S. strategy execution. Material credit issues or a failure to achieve consistent, profitable growth in the U.S. could seriously undermine confidence in their primary long-term growth initiative, reinforcing that valuation discount we discussed earlier.
So if you're keeping an eye on CIBC or the Canadian banking sector more broadly, what key metrics should you be monitoring? First, credit quality. Keep a very close watch on provision for credit losses, PCL, gross impaired loan formations, and overall loan loss ratios. These are critical near-term indicators of the bank's financial health and the broader economic stress on borrowers. Then, net interest margin, NIM, specifically excluding trading activities, which shows the true profitability of their core lending business in this evolving interest rate environment.
You should also pay very close attention to the U.S. commercial banking and wealth management segment performance. Its net income, ROE, and loan growth are the primary barometers for the success of their strategic diversification and long-term growth ambitions south of the border. Wealth management metrics such as growth in assets under management, AUM, and net client asset flows are excellent indicators of progress in building that crucial, stable, fee-based revenue. Finally, always keep a keen eye on their capital ratios, specifically the CET1 ratio, to ensure they maintain their strong buffer, which is a cornerstone of their financial stability and regulatory compliance. You need to see that stay solid. #outro back.
So we've journeyed through CIBC's strategic landscape, taking a thorough look at everything from its unique place within Canada's banking oligopoly to its ambitious U.S. expansion plans, navigating complex interest rate shifts and embracing a rapid digital transformation. We've seen a bank that's maybe a follower in terms of sheer scale, but a clear leader in strategic focus and digital adoption, buttressed by a robust capital buffer, even as it diligently manages significant concentration risks in the ever-important Canadian mortgage market.
Yeah, and what we ultimately see in CIBC is a bank actively and intelligently transforming itself to navigate a profoundly dynamic financial world. Its continued success isn't just about its own growth and profitability. It serves as a powerful reflection of the underlying resilience of the broader Canadian financial system and the ongoing, often subtle evolution of how all of us interact with our money in an increasingly digital and interconnected world. It's a compelling case study, really, in strategic adaptation within a highly regulated and mature industry.
As you reflect on CIBC's journey and the broader banking landscape, consider this provocative thought. In a world where technology is constantly shifting how we bank, and powerful economic forces are always at play, is the true competitive edge for a bank like CIBC really about sheer size and brute force? Or is it increasingly about agility, unwavering trust, and the profound ability to connect deeply and meaningfully with your evolving financial needs? That's all for this deep dive into CIBC. We hope you feel more informed, more curious, and certainly ready to look at the financial world and perhaps your own bank with a fresh and critical perspective.